And joining me on the podcast and on video, it's Russ Mould, Investment Director at Stockbroker AJ Bell. You all right, Russ?
I'm very well, thank you. Greetings from London.
Yeah, well, and how is London these days? Is it still
Uh,
growing?
it still seems to be an economy all unto itself. This
Yeah,
little private enclave that just powers along almost regardless of what's going on anywhere else in the world. So and my trains from Brighton to London just as busy as they were before the balloon went up. Now, I mean, they were, even on a Monday they're pretty much back to normal. So it does feel as if to me people are either being told or go back to the office or bored of sitting around at home or something. But it definitely feels as if, contrary to the valuations you're seeing for real estate investment trusts, it does feel as if people are going back to the office. So maybe that's a topic for another week, something we can look at.
yeah. I don't know if I saw who's the guy from the Bank of England. He's no longer there now, but he's saying what I find strange about the Bank of England, especially the Fed. You have
I
all these
find everything
members of the
strange about
Fed.
the Bank of England. How can 9 people know what the true price of money is? I find it absolutely bizarre. Anyway,
Yeah, but even with the Fed, you get people coming out, after meetings, giving their own opinion and swaying the market a bit. You're thinking, just keep quiet. All we need to know about is the official meetings. We
well, I've got
don't.
to be careful what I say, but there have been Fed officials in the past who've been trading like ferrets when they've actually been
Yeah,
sitting on the FOMC. So you've got to be very careful what you say because you could be accusing them of doing something that they shouldn't have. So,
yeah.
not naming any names, one of them just bobbed back up at Goldman Sachs.
Oh, did
You can
he?
track it, you can
Okay.
work out who it is.
Yeah. I don't know if you've seen any of these here today. We'll get on to oil and gas prices because they're
Mm.
quite moving around. But I don't know if you saw unemployment at 4.3. Got it right, forecast there.
There you go. Good for
4.3.
them. It's crept up a little bit, but the wage growth number I think was what's caught people's eye more than anything else, isn't it? Because it's
Yes.
still pretty strong at 5.7%, I think.
Yeah,
So and
stayed there.
that's the one thing that the Bank of England has been bashing on about consistently is being wary of a wage spiral, and strong wage growth will feed into services inflation, and that's probably stickier to get rid of than say goods inflation, for example. So that's
Mm.
definitely one thing that the Bank of England will be continuing to watch. Although again, I remain fairly concerned that by being data dependent, they're driving the car either looking out the side mirror or the back window, and therefore there's going to be an accident at some stage because they're really trying to set the price of money for 2 years down the road.
Yeah. I do think that it's very impossible to judge where it's going. And you think if you, it's that thing, isn't it? Acting at extremes. Like I said, they stimulated the economy to create almost a 10-year bull market.
Yeah, my
And now they
suspicion is,
get,
yeah. I
yeah.
mean, sorry,
Um,
Justin, please.
go on. And I think, what are they going to create now? They're holding them higher for longer. I have no real idea what the lasting effect is, right?
Yeah,
Because
my
the lag is
suspicion is,
massive.
yeah, human nature being what it is, they made an absolute mess of their transitory call, so they left it too loose for too long. And my guess, human nature being what it is, they'll probably leave it too light, too tight for too long because they'll
Yeah.
overcompensate and try and fix their previous error. Generals fight the last war, regulators regulate the last crisis, and investors hedge the last crash, don't they? So I'm
Yeah.
sure central bankers will prove to be just as human as the rest of us. That's not a criticism. It's just we are what we are. We are flawed. We get things right, we get things wrong, and for markets to blindly put their faith in central bankers, 9 individuals pretending they know what the true price of money is, well, I wish them good luck, but it's not always going to end well.
Yeah. Okay, this is the
Hopefully, it
price.
does, of course.
Yeah, exactly. This is the price of oil. And looking
Well,
back
you
here
tell me,
from
you're the chartist. I mean, that tells me it could go. Where is it now? 80. It tells me it could go to 100. It tells me it could go to 60. And I don't know which, quite frankly. But
yeah. Well, generally, I mean, if you look at all you can do is chart is look at some where it's peaked and see you know the last rally wasn't as pronounced as the previous rally. So the
yep,
last rally was what April, and it
yep.
hit sort of 91, 92 bucks. Back in October, it hit 96. So that's a lower high there. But you've also got this wedge here coming up.
Oh yeah,
So you're right.
look at the wedge. There you go. So at
Yeah.
some stage, when there's meat, it's either going to go up a lot or down a lot. Is that what you're telling me? I think that's what
Yeah.
happens,
Well,
isn't it? You normally get a decisive kind of moment.
yes, well, I mean, if it breaks this sort of line, I mean, this level
Ah,
here,
well,
so it's
that's
about
different. Yeah.
82, it's going to come down here, and you're thinking
Mm.
it's not supported. But of course, on the upside, it could break there. But who knows with oil? It's like if the economy is grinding lower and slower and sentiment is bearish, it could move lower.
I
But
mean, on the face of it, the
again,
UK, yeah,
low
the UK
prices.
economy,
Yeah,
yeah. I mean, on the face of it, the UK economy is doing a bit better than thought. Now, the American economy, the Q1 GDP print wasn't brilliant. I mean, overall, trying to boil oil down. We'll come back to gas in a minute. Oil, yes, demand, and at the moment, demand, contrary to expectations and contrary to the hopes and aspirations of environmental campaigners, global oil demand is still growing. I know we
yeah,
have to consider the source, But OPEC thinks that global demand next year will be 106 million barrels a day. That's 6 or 7% higher than before the pandemic. So we still haven't reached peak oil demand yet, despite all of everybody's best hopes or best intentions. So that's one thing to bear in mind. A recession could change that, but even during recessions, oil demand doesn't seem to waver terribly much. Supply, there's all sorts of things operating here, whether it's sanctions on Iran and Venezuela, chaos in Libya, sanctions on Russia. You've got political and public pressure not to drill holes in the ground. So actually the oil majors haven't been. The capex to sales ratio across the super majors is 7 or 8%, bang in the middle of the historic average. And that includes renewable spending. So actually there's probably not an awful lot of new supply coming out of the ground, except for American shale. And Joe Biden's been doing his best to put the clamps on that.
Yeah.
And then you've got geopolitics, which takes us back to sanctions and wars in the Middle East and Ukraine. So there's so many different moving parts there. Anybody, really trying to predict oil, nah. The only reliable guide you've got is probably sentiment. And if everybody's really, really bearish, you should probably be bullish. And if everybody's really, really bullish, you should probably be bearish. And right now, it looks to me like everybody's sat on the fence. But what that does mean is that at $80 a barrel, look at what Shell and BP are doing right now. BP's buying back $3 billion of its stock every quarter. Shell's buying back $5 billion perfectly comfortably. Add in the dividends. That means that BP's offering about an 11% buyback plus dividend yield, and Shell about 9%, which all things considered doesn't look too dusty if you're prepared to swallow any ESG qualms or considerations that you may have. And some investors will, and frankly, some investors might not. But that in itself, is one of that is a big underpinning overall for the UK equity market in terms of cash returns. And we've done this maths before. Dividend yield of 3.5% to 4%, buyback yield of, call it 2%. Takeovers, if this BHP Anglo-American deal goes through, takeovers already up to about 65-70 billion pounds this year. That's 3%, 2.5% of the UK market cap, 2%, whatever. So 3.5 plus 2 plus 3.5, you're getting a 7-8% cash flow yield coming out of the FTSE 100 into investors' pockets. Maybe that is one of the reasons why people have started to look at this unloved and therefore potentially cheap stock market again.
Yeah, absolutely. I mean, there's one thing you can say here. There's definitely support on oil at around about 70 odd, 72, 74. Yep. So, I mean, I think OPEC tends to step in, doesn't it?
They do. That's correct. Yes, which is why, equally they don't want to put the hammer down and have it to go over 100 because they know that stokes inflation, higher interest rates, clamps consumer spending, clamps corporate cash flow. So that there's even they have got a kind of a balancing act, as it were.
Yeah, and you've got this bounce up there, hit the low there, and you've got a series of higher lows there. It's quite nice, but it's hit its head on this thing. So it seems to be a bit of.
And what about natural? What about natural gas? What about Henry Hub? I think that's that's from my crude charting skills, which are negligible. That looks like it's forming a bottom to me.
Yeah, well, look at that. Generally, a good time to sort of start buying gas is just after the summer, and it tends to rally quite a bit. If you go back, it's done that. But we had this really odd. I don't know what happened here. It just collapsed over the sort of in January, and has bounced off this low of 1.6. I don't know what this measures. MBTU.
$1 million per million British thermal units. MMBTU.
Yeah. And it's look at that gap there. Look, it's now breached. It's now closed that gap.
It's closed it, right?
Yeah. So that's quite good. So
that's and that again, there are people who would argue that BP and Shell are actually big gas, not big oil, because gas is a huge part of their business. And if gas starts to really go higher, as we saw a couple of years ago, then these companies are indeed wildly profitable. I mean, we've only talked about big cap oils here. I'm going to be absolutely honest with you. My track record with small cap drillers and explorers is shocking. And you've got to have, I think, a very, very high risk tolerance there and be very, very aware of the dangers. What have you got to look for? Well, first of all, you probably do need to have a bit of a grasp of the geology. You need to know the country in which they're operating. Is there any risk of resource nationalism or tax? You got to know, management's track record. You can know what the balance sheet looks like. Have they got, strong balance sheet to see them through? And do they have the capital to actually see them through to the completion of the project? And the answer is quite often no, particularly through delays. So very, very high risk, very, very high return. Lots of research needed. You probably need a basket of them, and just hoping that one of them makes it big, because a lot of the others will probably either run out of dough, make a mess of it, or a combination thereof. And so these are, quite literally in some cases, deep waters.
Yeah. Well, do you know what? I tend to stick away from them, especially wildcat drills, because the risk reward isn't there. And I know a lot of small cap private investors or microcap tend to go for them because they see the reward. They don't tend to see the risk.
They tend to be cash
So
sinks, unfortunately. Yeah.
yeah,
So,
absolutely, and it's almost like saying when you got something like that, they often say anything less, of course, than a 50% chance of success is odds against. So it's you're talking about horse racing odds pretty much. So it's a bit of a bet and a bit of gamble, pretty much. So I just think there's better risk reward plays elsewhere, and so I stick well away from the same as sort of biotech stocks going through clinical phase studies. It's very binary, and you don't really want that as an investor. You don't. I mean, okay, maybe play around a tiny little percentage of your portfolio, but I'm just thinking if you're going for a company that's either going to strike oil or not, and the chances are it's not, then to me that isn't a good
or
investment
even if it
thesis.
does, can it afford to get the stuff out the ground in the volumes
Yeah,
before coming back to you with the rights issue? Or okay, then maybe you think, oh well, they might get bought out by somebody. But buying something purely for a bid,
yeah. Or in fact, I mean, a lot of them do farming agreements, but even now
yeah,
we've had, I think it was Deltic Energies, a small cap company, was had, I think it was with Shell actually, but they've sort of pulled out, and so it's in the North Sea, and you get this now like a ESG problem, lack of investment in oil and gas, so it's not like it was, and previously there was a play where you'd, for example, invest in a company that's say got a drilling campaign 6 months down the line, and the shares would rise towards that, and the clever money they would de-risk before the actual drill happened, because the chances are it's 5 in 1, 10 in 1 chance of actually striking oil. So so the play is getting way before the drill starts happening, and they've got money for that drilling campaign, and
yeah.
hopefully the sentiment will push the share price up. But get out before the actual results come out, because the odds are it's not going to be like
it, it,
it's
it
not going to be successful.
it's a hairy business, and it's got to be very, very, a part of your portfolio that you're prepared to write off. If it works well, then there'll be a big multiplier effect. But if it goes wrong, you're just gonna have to be prepared to take your lumps there. So it is a tricky area, and if I was allowed to invest my own money directly, which I'm not, it's one I would be very, very reluctant to embrace,
Yeah.
just because as you said, the risk reward and the time involved in doing the research, it's pretty tricky stuff.
Yeah, well, this is an example of it's kind of a little Deltic Energy. Oh, hold on, too big here.
Here we go.
But they've said they're licensed in southern North Sea. They hold a 30% interest, and I think it was like something like who was it pulled out? Farmers. Someone pulled out, and
Mm.
they basically have gone into a bit of a rant saying there's no appetite now. In the UK, have created a problem for, and you see the chart there, but that
Well, I
was
guess
the
you've got
30th of
windfall
April.
taxes and
Yeah,
environmental pressure and all sorts of other things, haven't you? So,
yeah.
but I guess
So
the thing is, if you believe the OPEC forecast and think that we're going to need oil for longer than maybe we would like or expect, funny enough, the things that do look really, really cheap still, although they're generally US or European quoted, are the oil rig operators.
yeah,
Because at the
yeah,
moment, some of their fleets are trading at barely replacement value, which tells you again the market's kind of saying, well, oil schmoil, it's kind of a game over, right? But if
yeah,
that doesn't prove to be the case, maybe the people who supply the picks and shovels rather than do the drilling is as it was when the old gold mining rush of the 1840s might be the way forward. But again, that's again something you'd need to research, and you might want to look at overseas stocks. But on an asset basis, the drillers and the rig owners very highly geared into higher rig activity if there is any, and at the moment at least being priced as if there's never going to be much of a pickup again, which is kind of intriguing given that oil prices have probably proved firmer than most people would expect, certainly compared to 4 or 5 years ago when it briefly went negative.
yeah. I mean, this is an example. They released this on the 30th of April, and they've got this resource
Bomb.
in the North
Mm.
Sea, and they do blame. They say here, they've been looking to farm out part of this resource to get maybe a major in, maybe to pay for the drilling, and they have obviously take a share of it. But they said, the rhetoric emanating from Labour Party has severely negative impact on the ability of UK exploration, and now they're thinking of actually, withdrawing from that license. And so they're saying, and the CEO
Got to know
says,
where you operate.
yeah,
Political risk is always a
yeah,
factor, as we discussed. So
it's a real world consequence of our political leadership using nationally important oil and gas as a political football. So there's a lot of this, and I just think this is too much risk. I mean, years ago when before everything went sort of green and now the money's gone towards that, it was a play. But now it's one of those things, isn't it? One of those things. I think BlackRock called it a mega trend, and you think, okay, demand is still going up, but the money outflow is huge from oil and gas, from big players. I mean, I think there's a Norwegian sovereign fund a while back decided not putting any more money
yeah,
into
I think
oil
it
and
did,
gas
which
and
is
all that stuff.
ironic given where its money
Yeah,
comes from. But yes, I
yeah.
think that's correct. Yes.
And you think, well, if you just see that the level of money coming out, then I think the play in smaller cap, micro cap sort of oil and gas plays is done. And there's better places to put your money if you want. It's just it's a gamble. It's odds against gamble, these kind of stocks. And I just think, okay, if you got money to lose and that's what it's likely to happen, fair enough. I play around with it. But if you want return on money, consistent return, that's not where you put your money. It's you're better off getting.
You're certainly not getting much safety. You're certainly not getting much margin of safety anyway. Put it that way.
No, exactly. I mean, do you want to wake up in the morning and read an RNS and, like I said, what did that fall by? That'd fall by 47%. And that as a gap down there, 47%. And it continues to move
kept
down.
Going.
I know. So yeah, it's not a thing. It's a safer place to be. And in fact, like I said, probably the majors where you got Shell and BP checking out a nice dividend. And in fact, Shell's share prices.
It's all-time high virtually, I think.
Yes.
I think it's virtually at an all-time high. Look at that.
Yeah. Wow, look at that. Yeah,
deceptive, huh?
Yeah. So the big
and if
guys
it's returning 9% of its market cap a year in cash, you can kind of have some understanding of perhaps why that might be.
Yeah, exactly. Marvelous. Thanks for that, Russ.
Pleasure.
We'll catch up next week.
I look forward to it very much.